Sean, good to see you. As always, we're talking about the Fed's rate hike and how it's roiled the markets again. The markets fell following the Federal Reserve's 75 basis point rate hike. There was talk that it would be 1%. It's less than that. Still, the market's feeling very pessimistic. When we take a look at the S&P for the past month, we see a lot of red. So I want to break down, what do those numbers mean, the basis point rate hike, and what's behind all our pessimism?
I'll tell you, it's a nice chart in that it was bringing in the fall colors, but we don't want to be seeing all that red, right?
No.
Red indicates negative performance. The markets are reacting negatively because the Federal Reserve is increasing the interest rates in order to slow down the economy. We have a pretty robust economy still. Earnings are still good. The job market's been unbelievable. I mean, we're at still, a decade lows in terms of unemployment rate. And this is really feeding into that inflation. So what happens is when the Federal Reserve increases their rates, their intent is to slow down the economy. People will be spending less because it may cost more to borrow to buy that car, or we see now to buy that house. I mean, we've got mortgage rates over 6% now.
Right.
Businesses will be slower to grow because they are going to often grow through debt. And if the debt is more expensive, they're not going to be making those purchases. And of course, the unfortunate part of all this is we're going to see probably see higher unemployment rate. But a higher unemployment rate means a slower economy, less spending, and hopefully less inflationary pressures.
Mhm.
We're starting to see a little bit here and there. The wild card that we've really been seeing this year is energy. Energy
Mm.
is still very robust and is still really adding into that inflation picture.
Mhm. So now you said inflation a lot, and the point of these rate hikes, as you mentioned, is to cool inflation, but that really hasn't happened yet, still at 8.3%. So can we expect more rate hikes?
I believe we do. We're going to see a few more rate hikes from the Fed unless something breaks in the economy, which is the risk they're running right now. They're being very aggressive with these increasing rates, and the likelihood of something breaking. We don't know where it might be. It could be the real estate market. It could be something else. If something breaks, we'll see a pause in those rate hikes. But I see them continuing for certainly for the foreseeable future until we start to see inflation slow down. But the
Mhm.
problem is these rate hikes, it's not an immediate reaction in the markets or in the economy. You're going to have to wait 9, 12, 18 months to start to see these rate hikes take effect.
Mhm. And so what are the smart moves then that investors should be considering right now?
Well, on a personal home front, with this inflation, shop your insurance, turn your light switches off, things of that nature. Try to reduce your household budget. In
Mhm.
terms of your investment side, there's some safe money strategies you might look to employ. Some of them might be principal protected strategies, specifically they're called buffered notes. We can get into more details if you call us here, but buffered notes allow you to get some market participation if we have some upside with some insurance protection or some buffering, as we call it. So some protection of principal if we see some downside in the markets.
Mhm. Okay. And I'm sure it's probably better to be aware of those products or have that conversation before things get nutty like they are now. Um,
Exactly. It's important to think of these things before we see this volatility, before we see the markets declining like this. But it's never
mhm.
too late to try to look at them and put a plan in place.
Right. So though, at what point do I reassess my allocations depending on my risk tolerance? What if I'm going to bed after looking at my 401k or my other investments and I just can't sleep?
Well, I hope that we've put together a long-term plan, right? And a robust plan for your retirement savings or your investments overall should account for situations like this. So if you've accounted for it and you understand what's going on and you have a long time horizon, I would change nothing. Okay.
Mhm.
If you're really close to retirement, Aaron, if you're, around 65 age, you might want to reassess your allocation and maybe move some money over to those buffered strategies that I mentioned just to protect yourself going forward because it's really tough to take these losses when we're in our 60s. When we're in our 20s, it's actually great. It's a really
Mhm.
good buying opportunity right now when you see the
Mm.
markets at lower levels.
All right. Well, it was helpful to talk this through, and it makes me feel better. There are some other options out there. Sean, if somebody wants to talk to you more about something that you've mentioned today, what's the best way to reach you?
Oh, just please give us a ring. Our phone number is 603 715-2335. Give us a call. We can set up some time and I can answer any questions or concerns you might have.
All right, perfect. Sean, thank you.
Thanks, Erin.